I want to thank you so much for joining us again for our monthly webinar. We exist purely to help our clients out of mortgages, not deeper into mortgages. And we've kind of made it our mission to be advocates for our clients. In other words, to poke at some of the stuff that are not good for clients at all, okay? The financial industry is I'm in the industry, so I'm speaking about myself. I'm not speaking ill about it. Without financing, we can't buy houses. Let's be very frank. We have a very safe banking system in Canada and a very stable banking system in Canada. So for that, I'm deeply, deeply thankful. But the financial industry is a bit of a black box in the sense that, there's so much that we can know, but is not shared with us. Partially because people are busy. I don't think it's necessarily sinister. Part of it can definitely be shared, but people just don't. And so our job is to kind of show that to you. We believe it's in your best interest, in fact, in our best interest, to make sure that you know everything you need to know about a mortgage, okay, about your mortgage. Now, is it possible to know every single thing? Oh gosh, I've been doing this for 15 years and I'm still learning. I learned today again, something I never knew. So there's no ways you can know every single thing, but certainly we can try, right? So tonight what we're going to do is we are going to cover what is your mortgage's sticker price, and then what are life cycle costs. We'll talk about that also, and how they compare with the sticker price of your mortgage. And then we'll cover various aspects of the life cycle costs of a mortgage. Now, there's going to be 19 topics here, okay? We are, believe it or not, going to cover these in a series. So once you're done with these, you're going to be almost 2 years older later on, okay? When we're done. But once you know these things, you really, really should be in the driver's seat about your mortgage. You should really know what to ask for. I think you'll never want to, or never have to put up with any kind of let's send you an interest rate and get you a mortgage. I just don't think it's fair to clients at all. And then, of course, we'll have Q&A also at the end there, okay? Okay, so let's dive in here. So what is the sticker price of a mortgage? Well, just like the sticker price of a pair of shoes or a car is the actual price. That's what you see. Pair of shoes, $125. That's the actual sticker price of the shoe. In a mortgage, the sticker price is what you see about the mortgage, right? It is the contract interest rate that determines, amongst other things, your mortgage payment, the interest you pay, blah, blah, blah. Of course, there's a whole bunch of factors that go in there. And so your sticker price is what most of us are it's been driven into us. You gotta know about the rate, ask about the rate. I actually think it's almost epidemic. Like, I've got clients calling me. I have empathy for that. I really do. It's not criticizing. Is that they'll call me, won't introduce themselves. They'll just say, "What's your rate?" And I'm like, "Gosh, that's like." I normally pause because I don't know where to start. I normally go with, is that the only thing that's important to you? And then most people are like, wait, why is that broker asking me that question? And then kind of we have a good conversation about it. But yes, the sticker price of a mortgage is important. That's why we talk about it. And you'll see it's the very next thing we'll talk about in our series will be the actual interest rate. Because nobody wants to get a higher interest rate and go, I love doing business with Mortgage Allies and Jacques. They hug very nicely, but they're expensive. Nobody wants to do that, right? We want to make sure you get a very competitive interest rate that's going to be sustainable for a long time. All right, let's dive in here. So let's look at the bigger picture here. And once you understand the whole picture, not just the interest rate, and you will see that financial institutions literally use the interest rate to distract you from other costs in the mortgage. So let's use an example. I always kind of use this, forgive my little silly painting here. So imagine this is a car looking from the top, okay? And let's just say this is a Rolls Royce, okay? It's like a gazillion dollars worth. And there's a baby here, okay? Baby sits and plays there in the showroom. And this is like a gazillion dollar car. And you take a baby rattle, like a cheap toy, dollar toy, and you keep it behind your back. You don't show the baby the toy, and all the baby does is looks at this beautiful car. The moment that you go and you take that rattler and shake it, it's gonna go completely lose interest in that most amazing car, and it's going to focus on that $1 rattler. Now, I'm not trying to be demeaning you or anything like that, but we are very much the same. Okay, so in other words, our rattler is interest rates. Okay, and banks know it. Okay, so in other words, they rattle their thing, interest rates, and then we go, oh, gee, that's an amazing rate, and that's where the questions start. We do that with other things too, for sure. I'm guilty of it. All of us are guilty of it, okay? So what I'm trying to do is to focus, to get our attention on what really matters, this, not the little rattlers, or like what is going on behind the picture, okay? And the reason why I do is because I see this so many times, that a mortgage's life cycle costs can far exceed the interest savings from one rate to another. So in other words, let's be clear, like there's no miracle rates in the industry. It's not like, oh gosh, I got 1.5 from this guy and the other one gave me 3.5 for a prime mortgage. That's not going to happen. If you're going to get anything better, it's like 0.1 or something like that. It's not a lot at all. So you're kind of like, okay, wow. So between one rate and another rate, how much can you really save? Right? Not much, 10, 15 bucks a month. I'm not saying it's nothing, but what are you giving up? That's the question. What do you give up? There's no love in banking, right? There's no, oh, you're so nice, we're just going to give you some extra money. There's no love in banking. I mean, I am thankful that we have a stable banking system, but our financial institutions are of the wealthiest and the most profitable in the entire world, okay? They get this thing. They market like pros. They really do. They are absolute masters at lifestyle marketing and playing the right thing for that they know clients will go after. Doesn't mean it's good for clients, but they know that, okay? And so what we want to make sure is that we don't sacrifice or incur or open ourselves up to a whole bunch of other expenses or risks at the cost of 15 bucks a month, so to speak, okay? That's what we talk about, the life cycle costs. All right, so let's use a few examples. Kind of to give it context, I use a few examples, okay? So let's take two pair of shoes. These are kind of, let's just say they dress shoes, and you go to a popular box store and you see a pair of dress shoes there for 140 bucks, and that's the sticker price, okay? And there's another pair of shoes for 600 bucks, okay? And you go like, gosh, like, you know, this is obviously the pair of shoes I'm going to buy here. And so I always ask my clients, as I say, which is the more expensive shoe? And they look at me like, if you don't know that math, buddy, please don't do my mortgage. And I go, yeah, I hear you, but it's not that clear, okay? If we look at the sticker price, this is by far the winner, okay? So if you look now, and we compare the actual life cycle cost, okay? So watch here. If we take these two pair of shoes over 20 years, well, depending on how much you use them, okay, apples for apples, this is probably going to last you 2 years, okay? This pair here is probably going to last you 20 years plus with some resoling, okay? So in other words, these quote unquote expensive shoes may end up costing you about half, if not a third, of what these shoes will cost you over their life cycle. So in other words, you know, again, if you had the cash flow, which is the better or the cheaper pair of shoes to buy? These ones actually, right? Not those ones. Okay, and if you look at how shoes are manufactured, for argument's sake, there is exactly what they play on, right? So these may not have stitching or anything like that. You wear the sole through, it's done. The uppers may not be leather, etc. A whole bunch of things that they put into the life cycle cost of the shoes, where these ones are very sustainable, last you a long time. Let's take one more example. In fact, two more examples. Let's take a car. Okay, we go to a car dealership. I don't think any of us will go to a car dealership and say, I'd like the cheapest car on your lot. Well, first of all, what's going to happen is you are going to get the cheapest car on the lot, right? And we won't do that because we know intrinsically you get what you pay for. There's no miracle, oh, this is the cheapest car on the lot, but it's the most maintained and the best car on the lot. There's two completely opposite scales there, right? And so we know if we take that cheap car, well, guess what? You're probably going to end up owning the most expensive car you've ever owned because you have to put a bunch of repairs into that vehicle to keep it going, right? So, so that's another example of life cycle cost. The sticker price of a car may be cheap, but the life cycle cost will far exceed the price of a car that was maybe slightly more expensive, but was better maintained and would cost you less over its life. Okay, so here's something I really want you to think about for a second. So who must ever go to a financial planner and say, hey, financial planner, I want you to work on my retirement planning, but I want you to assume that everything will be perfect and my money will always be increasing. The markets will be completely increasing all the time. There will be zero risks and absolutely nothing will go wrong ever. Now, if you're a financial planner and somebody came to you and said that to you, probably like, it'd be probably like a deer caught in truck headlights. You'd be like, what? Like, that's delusional. Like, you just don't get that. It's not reality, right? And so we'll talk about that in a second about mortgages. Okay. Instead, we want our financial planning to reflect reality, be achievable, and incorporate various what-if scenarios, etc., to make sure we can retire safely. So what do you do with mortgages? Most people literally assume that nothing will ever go wrong, everything will be perfect, and rates will always go, be nice and low. And so your needs will never change. Of course, your needs will definitely change, and rates will definitely change. So you have to bake into that mortgage a whole bunch of what ifs, what if in 3 years' time, what if in 5 years' time. You got to bake that in. And that baking in is what we call the life cycle cost of the mortgage, literally. Okay. And so that's what you got to be careful of. All right, very, very careful of. And so we'll talk about that also. Okay. Okay, so how do all of these things apply to mortgages? One thing I've noticed though is with mortgages is we don't apply the same common sense logic to mortgages that we apply to that, like I just explained, like a car or a pair of shoes or financial planning. I have talked to some people, not my clients after I've spoken to them, but people off the internet will call me and say, what is your interest rate? And I'll say, well, is that all you want to talk about? And they go, well, is there anything else important about a mortgage? And that's exactly what happens because they haven't used the logic that says, wait a second, this is a complex thing. There's a lot of money I'm loaning. So there's got to be something very important about it, right? And I think we're not suspicious of too good to be true miracle rates. Here's a good example for you. Why is it that variable rates are so low right now? Okay, so we'll chat about that in a second. That should make most people suspicious. In fact, again, all things being equal, don't take it too far, but to say this, you typically, whatever your bank sells like crazy, you should not buy, literally. Okay, because it's designed to profit them more than you. Okay, and so whenever a broker gets incentivized from their bank to sell you a specific product, do you think they do it out of goodwill? Not a chance. They do it because they know they're going to make lots of profit on that product down the road. Okay, and so you got to be careful with that kind of stuff, right? And so why is it also that people will take a product from a bank and don't even understand the product? We get some very complex financial mortgage products, yet most people don't understand it. And that's not necessarily the client's fault. It's the provider who's got to teach them. Now, let's just say that they do teach. Let's pretend they do. Then you got to be really bold as a consumer to say, well, what does that mean? What does that mean? To poke at it, it's really important, right? Until you understand it. Here's another one right now. Why is it, so I'm poking at brokers too, not just banks, right? You can see here, why is it that my broker is so eager to sell me a 4-year mortgage term when rates are at an all-time low? Why is it? Okay, that's like nobody asked that question. Like you'll get probably a 4-year rate for about 0.1% lower than a 5-year rate. So should you take the 4-year rate? Well, we'll chat about that also. That's very important. Okay, so the question again is, why is it that we are not more curious about our mortgages? Because I truly believe, I actually lay the blame, if I have to call it that, at the feet of the industry, at brokers. because we have also played into this game of dumbing down mortgages and not actually treating with respect. In fact, we've conditioned clients to actually get the lowest, only ask about the lower interest rate. Let me say this to you, okay? I'll talk about it in the next day, but I'm going to just say this to you. As a broker, okay, we operate in discounted rates. I do not have the ability to give you a rate higher than what I have on my rate sheet. I don't. Like if I submit an application with a rate that's higher than what I have available, I'm going to get a phone call in 5 minutes, or I may not even get a phone call. They just give me the lower rate anyway, right? I don't get incentivized for selling you higher rates. I cannot, physically possible to do that, right? Banks can, right? And so for brokers then to kind of play the rate game and not educate clients to make sure they get the right mortgage, which include the right and low interest rate, I don't know why they don't do that. Maybe just they're too busy. Okay, I've made it my busyness to do that. Okay, and also the other thing is we don't know what to ask. Like if I went into your workplace tomorrow, okay, and you spend an hour with me and you say, hey, Jacques, do you have any questions? I'll probably go, I actually don't know what to ask you. You know what I mean? And so I know when I go with my clients through our analysis, I take an hour and I kind of warn them up front. I go, listen, man, there's so much information to share with you. If I go too slow, I'm probably going to go, put you asleep and you'll never want to talk to me again. If I go too fast, you'll probably think I'm hiding stuff from me. So kind of like it's like in between that, running the gauntlet between those things. Okay. And so when we educate about the life cycle cost of your mortgage, that is when you can ask good and relevant questions and put you in the driver's seat of your mortgage. I love clients who ask me lots of questions. I have learned more from those clients than from anybody else in life, okay? And I'm going to tell you, those who ask good questions always get the right mortgages, always do. I've got clients with very, very modest incomes that are almost mortgage free, okay? And that they would earn, gosh, a fraction of what some of my clients earn, okay? It's because of that curiosity that they've developed. Cool? Hopefully this is helpful to you so far. Okay, so what are the mortgage lifecycle costs? You're probably saying, Jacques, I thought you were never going to ask. Okay, so you can see what are life cycle costs, okay? Life cycle costs are mostly unknown. That's exactly the problem. They're often hidden in terms and conditions or may become only relevant later during a mortgage term, or if they're there, they're left to chance. Okay, it's never going to happen to me. Remember we spoke about if you go to your financial planner, you would never go to your financial planner and say, listen, I want you to plan, life is perfect. Nothing's ever going to go wrong. Well, you would never leave your financial planning to chance. Don't do it with your mortgage. It'll cost you a lot. Okay, and problems with some of these life cycle costs, they're very hard to calculate sometimes. We can calculate them. Okay, certainly you can on probability, but because they're hard for people for the institutions to wrap their heads around, they kind of leave them out, right? Okay, so life cycle costs are intentionally or unintentionally benefit the lender more than the borrower. So lenders would create products that force the borrower to be loyal to the lender. So in other words, if you create a product that it's hard for the client to leave, or if they left, it would be more expensive for them than to stay with you, well, that benefits you, okay? Or it may restrict or limit the borrower, okay? It can prevent the borrower from saving money also. These are real costs associated with them, okay? And they can cause the borrower to incur debilitating costs. So let me give an example, okay? There are probably right now, I'm taking a guess, 30% of Canadians that are sitting with interest rates in about the 3.29 or something like that rate range, okay? Now, rates have gone slightly up right now, but those clients, we had in July, August 2020, we had rates of 1.6, 1.5% 5-year fixed. Those clients were looking at those 1.5% rates and they could do nothing about it because the cost to break that higher interest rate to get the low interest rate would far exceed the savings from from the lower interest rate. But that is unique only to some financial institutions, not all financial institutions, okay? And that's the what if you need to bake into your mortgage, okay? And those costs can obviously far exceed the upfront savings that you saw from that shiny interest rate when you took the mortgage on, okay? So the mortgage sticker price, as I said before, is the interest rate is literally there to distract the borrower from inquiring, discovering, and understanding the mortgage's life cycle. Do an experiment, okay? Go to a financial institution next time and they kind of give you the rate. Ask a bunch of questions. They would not know what's hit them. It'd be quite funny to see, actually, okay? In fact, in my opinion, this has become so serious that most brokers or banks would only email a client an interest rate, and the client would proceed on with a mortgage based on just that. Like, that is not wise at all, okay? And in fact, what I do with you tonight, I spend at least twice with every client. We spend an hour with each client at least twice in there before they sign their mortgage documents, okay? And so there's education, there's this back and forth asking. We actually do what's called a CMNA, a client mortgage need analysis, where you can actually say, I want this, I don't want this, be careful of that. You can actually go through that. And for me, that's the right thing to do. This is not self-serving. This is what I think the industry should do, especially when it comes to financial products. Cool? Right. Now let's dive into the actual life cycle cost of the mortgage. So there's 19 of these. I'm not going to dive into these individually a lot. As I said, I'm only introducing them tonight, and we will go through these one at a time over the next months, and we will actually deep dive into all of them so that you can literally get the most value you can possibly get from them, okay? So interest rates, yes. Oh, it's number one. Look, number one in my list, as I said earlier on, I don't want any of my clients to say, oh, Jacques, he gives amazing hugs. Oh, he educates amazing, but the guy's rates are very high. Like, I mean, that's absolutely ludicrous, right? I would never do that. So you got to be competitive in the space. That's what we are. So we have status with pretty much all the lenders out there. We get the best products and rates in the industry. So that's not an issue, okay? We should actually put a segment in how you should vet your broker. I think that would be a very good thing for you to understand also, okay? So we're going to talk about interest rates. What is the difference between one interest rate and another? Here's another thing for you to understand. I don't know of a single client that can say, certainly my clients said, oh, I became mortgage free because I had the lowest rate. Most of our clients will say, I became mortgage free because I had a plan, and my broker, Mortgage Allies, helped us achieve that plan. So every year I would say, do you want to increase your payment? And they would pay the mortgage off. That is the reason why people, pay off their mortgages. It's just like an Olympic athlete. They don't win it because they have a better protein powder. They don't win a gold because of protein powder. They win because of a coach and their plans and how they do things, right? Cool. Lender philosophy. This is a big one that people don't necessarily understand. So how we do anything, we do everything. My poor children, they are not in this webinar tonight, but if they watch this tonight, they're rolling their eyes, okay? This is me always saying, you do anything, you do everything. So you can actually know how your lender is going to behave. If it does certain things this way, then watch the other things will probably be exactly the same, okay? Lenders have certain philosophies. What are the conflict of interest? Here's a good conflict of interest, not evil, simple fact. Your lender makes money from you paying interest, okay? Gee, Jacques, that was profound. No, you're right. It wasn't profound. But here's the reality. You are paying the interest. So the longer the lender can keep you in a loan, the higher its profit. So it'll create products to keep you there in that product for as much as you can, for as long as you can, right? So that's a conflict of interest you need to be aware of, right? Okay, here's a big one in our market today, 26 October 2021. What is better? Fixed or variable, right? A lot of people say, oh, Jacques, absolutely, I need to take a variable because it's always better than fixed. And I go, sigh, maybe. But if you look at right now, I mean, we've got variable rates right now about 1.2%. Okay, that's ridiculously low. Okay, and prime is at 2.45. So do the math. It's very, very low. Okay, so what's the issue there? Remember I told you, if a bank sells something like hotcakes, you should probably not buy it. Okay, because typically, if you look at inflation, January it was 1%. Today is at 4.4%. Right, 10 months. Okay, so what does the Bank of Canada do to pull in inflation? It raises rates. Every financial institution can tell you now, it doesn't take rocket science to tell you that probably if inflation goes on, the bank is going to pull inflation back by raising rates, and it's probably going to be sooner rather than later. So again, be careful, very, very careful, right? Then the other thing is planning and strategy. How much is your financial institution or broker doing to educate you and give you options? Last webinar, we called it Show Me the Money. We did a full analysis, show you what we do for our clients, all that kind of stuff, and what every institution should do for their clients, okay? But, so in other words, my question is it okay for a mortgage advisor to give you a mortgage, not ask you about your plans, what your goals are, how to get you mortgage free? Is it okay? No, it shouldn't be, right? How will this mortgage affect you in the future? Will it help you to become mortgage free in the future, right? And so if that's not happening, alarm bells should be going off. If the person never meets with you, texts you an interest rate or emails you an interest rate, that should be a caution for you, right? These are all things that add to the life cycle cost of a mortgage, or can add to the life cycle cost of a mortgage, okay? The product type. Well, we can spend a month of Sundays on this, right? Banks' product types, they are designed to sound amazing. Most banks will only sell the benefits, but they have some serious backlashes to that you should be very, very careful of. We talked about this a little bit earlier, is that prepayment privileges are not the same for all financial institutions. Watch my body language. I kind of slowed it down there because I've spoken about this so many times over. Okay, some institutions, depending on the rate environment, can be 7-8 times higher than other institutions. Okay, so that's where that's the what ifs. This is where you're like, okay, what if this happens? What you need to pay attention to that. Okay, I always say, are you okay with not even necessarily taking a slightly different interest rate to make sure that if something goes wrong, you're good. That is so important for you to know that. Advocacy and support. So many of the financial institutions that we place mortgages with, once that mortgage closes and the client's asking for help, no can do. Like, no, leave broker. And so the client's like, oh man, like, where's my broker? I need some help. They placed the mortgage here. You can't help, right? And so always my caution is, if you want to make sure that somebody can be your advocate and make sure they can fight for what you need and help you achieve what you need. Very, very important. Poor support has a real cost implication. Very much so, okay? Insurance. I do not sell insurance or advise on insurance, but having insufficient, unsuitable, or no insurance can actually cause you significant financial hardship, okay? And there is insurance that is not necessarily good for you and other insurance that there is. And so you do need to be aware of that, right? So mortgage penalties, I actually did flip these two. Prepayment privileges, my apologies, these are mortgage penalties. Prepayment privileges is how much you can actually pay extra on the mortgage and how you can pay it extra, when you can pay it extra, can you reduce your payments if you increase them? That's what I mean with prepayment privileges. And it's something that very, very few people ask about, and you really should be. So we talked about this a little bit earlier on, the term length. Well, should you take a 1, 2, 3, 4, 5, 7, or 10-year term? What should you take right now? Okay. And so what if you want to get the best kind of longest term, but not be locked in that long? Is there a possibility? Yes, we can set something like that up for you. Okay. And so I always tell my clients, we always say in the industry, when rates are low, you go long. When rates are high, you go short, because you want to get out of that mortgage quickly so you can get into low rates if they are there, okay? So right now, anybody, or certainly depending on your needs, anybody sells you a 4-year term for a 0.1 reduction in interest rate, I go, nice one. And that only benefits the bank, because let me tell you something, the bank has done their math. What they do is they sell you a 4-year term. That last year, they give you a 0.1% reduction. That last year, when rates go up because they're lower than the lowest they've ever been right now, they will make your profit back here, no problem. So don't let them dupe you into that kind of nonsense, okay? All right. I'm not too intense, am I? I love this topic. I love to educate my clients. So terms and conditions. So people are like, well, Jacques, terms and conditions, I just read my mortgage commitment, right? And I go, not so much. There's actually more than one set of terms and conditions. You got your mortgage terms and conditions right in the mortgage. Now it will refer to other terms and conditions, what we call standard charge terms. And mostly you only see those at the lawyer, okay? And guess what? You only see that 2 days before the mortgage closes. Okay, so now let's say you go to your lawyer, okay? And typically, forgive me, lawyers, if that's not what you do, but typically your lawyer does not go through those terms and conditions with you line by line. Because if you want them, they'll go, oh, I'll do that at $600 or whatever rate, $400, $300 an hour. I'll do that all day long. And the client goes, gee, that's way too, I can't do that. And so what happens is you kind of like, you stuck there. So, but let's just say you do understand something about the standard charge terms and you like, oh, I'm not doing this. I'm not doing this anymore. Oh, you got 2 days, your mortgage closes. You got no time to back out from that, right? So we got to be very careful to understand that, right? And can I say it? Nobody's going to throw stones at me. That's why I meet with you virtually, so you can't throw stones at me. Just kidding, okay? That's a dad joke. I can see my kids rolling their eyes again, okay? So borrower short-sightedness, okay? I think we need to expect more from our financial institutions and brokers. We really do need to expect more from them. And I think we, in that sense, are causing our own problems, okay? We need to sit again and say, wait a second, what's going on with this mortgage? What should I be asking? Being incurious about the mortgage, it's kind of not asking all the right questions, increases your chances to incur significant life cycle costs, okay? I always say, any business person will tell you, if you go to, you should expect a lot from your provider. Okay, any good business person would totally be on side with that a client should expect of us to provide value. In fact, I love it because 3/4 of my competitors are gone. Okay, I expect my clients to expect value. But if you go to any, let's just say you go buy a car, okay, and you say, and you demand a whole bunch of stuff from your car sales guy, guess what he's going to do? He's probably going to give you the very minimal. He's probably not going to partner with you, et cetera, et cetera. Okay, so there's yes, you as a client, you want to make sure that you insist on quality, but make sure that you, quote unquote, for lack of a better word, partner with your mortgage person so that there's a quote unquote relationship that you can work through things with. You'll probably get the best you can ever get from them. Okay, so I'll probably just give you a tip there, but that'll save you gazillions of dollars right there. Okay, the term type, this is very confusing. What is a closed or open term? Most people say, oh, a variable is open, a fixed is closed. It's not true. Both can be closed and both can be open. What is a truly closed term? That is seriously, seriously bad. Here's a truly closed term. A truly closed term means you cannot get out of that mortgage during the term unless you actually sell their house. Yes, here's a true story. Clients of mine want to put in a pool. They asked me to refinance their mortgage. I didn't place the mortgage, the original. And so we submit the application and went all the way to the lawyer, didn't know anything better. The lawyer says, nope, cannot break this mortgage. They want to take $150,000 out to put in a pool. Sorry, can't continue because this is a closed mortgage. You have to wait until the renewal date. Yeah, it happens. So be very, very careful. Okay. Your amortization. Okay. How can your amortization? Amortization is the time period it takes to pay off the mortgage. If you only pay the minimum mandatory payments and the interest rate don't change for the entire mortgage term. That's not reality, but that's kind of how we have to define it, okay? So how can the amortization cost you money? It can, absolutely can, right? So we talk about that. Mortgage rules, oh, this is pesky, very pesky. You gotta make sure you are with the right lender, because here's the reality, okay? So let's just say you got your mortgage in 2016 before October. There was no stress test. It was la la land, right? The rate was that you got was the same rate you qualified at, right? So you're like, woohoo, I qualified for a mortgage, no problem, okay? Come 2021, and you don't like your financial institution anymore. Now there's a stress test, and let's just say one of the couple stopped working to be a primary caregiver to the kids, and there's only one income. Now you have to qualify for that mortgage. Well, but you don't like your financial institution. Now you want to move to a different institution. You may not qualify, right? So you want to make sure you know those rules so that you don't get, I mean, nobody can see 5 years from today. I get that, okay? But you want to make sure there's at least explained to you what happens to them. Payment frequency. So there's so much confusing here. What is the difference between accelerated or rapid payments versus normal non-accelerated payments? Okay, a lot of people think they're the same thing. They're not. Okay, so normal accelerated, non-accelerated, normal biweekly or weekly payments do not actually pay your mortgage off significantly at all. Very minimal. Accelerated does. Okay, because it's kind of baked into, you pay extra on your mortgage just because it's accelerated, okay? But I always say to my clients, if you went to your bank to say, look, I'm looking for accelerated monthly payments, they'll be like, what? We don't have that. And I go, well, I can calculate the accelerated monthly payments for you, and then you can just go and set it up yourself, okay? So don't let them be duping you into, forcing you into their can. You can do everything and do what you need and not break your mortgage rules, right? Down payment. How much down payment is needed, and how can your down payment affect your mortgage life cycle cost? Significantly, okay? We'll walk through this. There are certain break points where you actually save more money or less money. To a point, you got to be careful. It's never wise to put all your money into a down payment, because if you hit any COVID-19, we don't have to explain that anymore, right? And you have any no savings, that could be catastrophic. So you don't necessarily want to do that, okay? Portability is when you, in essence, there's a lot of terms and conditions attached to this. When you sell house X and you buy house Y, and you want to take your mortgage with you once you qualify for it. That is portability. Now, there's lots of pitfalls there we're going to talk about, okay? Assumability, again, in essence, is when you own house X and you're going to sell house X and just get out of the market. You got a transfer to Hawaii. If you go, just invite me with you. I'm sure they need another mortgage broker down there, okay? But assumability means that you sell a house, you don't want to buy another house. Somebody can qualify, a buyer can qualify for that mortgage and assume it, take it over from you. They get the interest rate or a blended version of it, and you don't pay a penalty. There you go, match made in heaven, okay? That's important to you. So you can breathe and I can breathe now. We are almost done. Here's what I always say about mortgages. I am not naive to the fact there is very, very little sexy about mortgages. Like if Tim Cook and I stood next to each other, I am 100% Tim Cook of Apple. He would get 100% of the audience and I would get a big fat egg, okay? There's nothing sexy about mortgage, but here's what I've learned, okay? It's like people say, well, Jacques, finances, I'm just not good at finances. And somebody once told me, it's like somebody driving in the 401 and the cops pull them over and give them a ticket for reckless driving, and they go to the cop and say, look, police officer, I'm just not good at staying between the lines. Like, no, the cop is going to say, no. There's no option. You gotta be good at staying between the lines, right? And it's the same thing with mortgages. It's boring. It's not sexy, but here's what I've learned. Successful people master and even eventually love the mundane. So thank you so much for joining. This is my cell phone there. This is our text-only number. This is our address, but we have worked virtually from June of 2019. 2019. Okay, so we did not go virtual because of COVID. But yeah, this is our official office address, but we're not really there. And of course, do check us out on all our social media links. And other than that, I do want to thank you so much for your time, and have yourself a great great night. Bye-bye for now.